Everybody, my name is Dhruv Bansal. Thank you so much for attending this talk. I'm with a company called Unchained Capital. Can we get those doors shut in the back? Does somebody mind doing that for me? You walked in. Would you just
Can we shut the doors in the back and put your mic right up
to me? Okay, that sounds great. Oh, thank you. Thank you. Okay, great. I'm with a company called Unchained Capital. We're based here in Austin, Texas. You can see Austin, Texas. I'm going to talk to you a little bit about what you can do with your cryptocurrencies today, other than just hold them and other than just sell them. Sometimes it feels like those are the only two choices. Keep doing that, Paul. I'm going to forget. Just thank you. Sometimes it feels like those are our only two choices. I'm going to discuss maybe some third options. But before we get into that, let me just very briefly let me do a quick survey. I'll do a quick survey here. Okay, so please raise your hand. No incremations here. If you hold any cryptocurrency at all, it can be Bitcoin, Ether, some ICOs, whatever you want. Okay, not surprising, right? We're all at the conference. Keep your hand raised, please. Keep it raised now if you have spent that cryptocurrency, Bitcoin, Ether, whatever it is. Spent, I mean something very specific. I don't mean like you bought ICO tokens or you exchanged Bitcoin for Ether. I mean you bought a coffee or you bought some good or service or something like this, right? Keep it up if you did it in the last year with that coins. Okay, that's awesome, guys. Well done. Next, the last 90 days, lower your hand if you didn't spend. Okay, cool. What about, let's say, a month? Did you buy anything in the last month with your crypto? A week? A day? Okay, a few people. Not today. Something with, okay. Okay, what's the point I'm trying to make? It's a very obvious point. We all kind of intuitively know this, is that many of us are holding these tokens because we think they're going to go up in value, right? They are perhaps a store of value, if you want to use that term. They're perhaps a speculative or otherwise a form of investment. We tend not to move them very often. And I have data to back that up. That's one of the things I really like about working in Bitcoin is one can make claims that are backed by data very easily. This chart, it might be a little hard to read. It's a little far away. But look at the colors. On the bottom, you're seeing time, 2010 or so, 2008, the beginning of Bitcoin's history, to about the present day. The colors here you should associate with how often the Bitcoin of that era is being moved or spent. So the hot, warm colors indicate the fraction of coin that is moving very quickly, once a day, a week, a month. The cooler, bluer, greener colors, that's the coin that's old. If you guys know what a UTXO is, I'm plotting the UTXO age distribution as a function of time here. All right, so what do we tend to see? We tend to see coin gets older over time. There's coin today, which is more than 5 years old. It hasn't moved from the address it's sitting in for more than 5 years. 60% of Bitcoin today, I forgot what the price is. What is that figure? That's like $60 billion perhaps of Bitcoin hasn't moved in over a year. That's tremendous, right? Like we all believe in this asset, we think, we hold it, we want it to go up in value, but what is it really? It's mattress money if it just sits around, it doesn't go anywhere. It's our contention at Unchained, 60% of BTC hasn't been used in 12 months, it's our contention and our mission at Unchained to get this coin to move, fundamentally. We think that's a value in and of itself, and I'll kind of describe that. The method by which we're going to get it to move today is by giving loans. I'll describe those too, but let me first kind of explore this idea of why this is even bad in the first place. Why is it bad? You have a question?
How much of that old
is lost? It's a great question. Always comes up. I don't know. What do you think?
Can you repeat the question?
Yeah, let me repeat the question. Thank you. How much of that 60% of coins or whatever in any era is actually lost and not just sitting around? I don't know the answer to that. It's a very, very hard number to estimate. My own personal guess is 20 to 30%, somewhere in that range. I've heard higher estimates. I've heard lower. Curious for your guys' opinions on that at some point. But I'm sure not all of it is lost, as my coins are part of that cohort that hasn't moved in more than a year. I dare say some of us who put our hands down are part of that cohort as well. So let me discuss why I think this is bad. Why is it bad that Bitcoin doesn't move around, that it sits somewhere? Okay, it's a lot of bad jokes on this slide. It took me too long to think of. In the spirit of Texas, right, in the spirit of the university, in the spirit of Bevo, I present to you the cattle collateral battle, okay? It is a battle for cattle collateral between, on the one hand, Uruguayan cattle, and on the other hand, American cattle. And of course, I really mean it's a battle between the cattle ranchers in each of these environments, et cetera, et cetera. What are they battling for? Oop, I didn't press the button, there we go. U.S. cattle, okay, great. What are they battling for? Literally, it is the idea of using cattle as a form of collateral. This is a thing that ranchers do, at least in America. It's very common. It's not as common in Uruguay. By the way, this analysis is based on a really interesting article from a little while ago, but I think the ideas still kind of apply here. There are some fundamental differences, it turns out, between the way American cattle markets and legal things are structured as compared to Uruguayans along three major dimensions, at least as identified in this study. And none of them are maybe what you think they might be. The first is legal issues, right? It is difficult to define in concise, simple to use ways what do you mean by taking cattle as a form of collateral, right? It's not clear. These cattle here, well, okay, how do we know that they're all the same? You have to tag them and identify them. These calves, well, they grow up. The ones in this field, well, actually now they're in this field now. It's needlessly too precise. In America, that is not the case. You can say, I have a lien or I have a loan for $100,000 worth of cattle. You don't have to go much beyond that in the description. So that's very helpful. There's some organizational difficulties. When you borrow, you typically need to put the fact that you have borrowed into a registry of some kind so that other lenders know that you have borrowed. This is not a great system in Uruguay, apparently. I've never taken a loan in Uruguay. I don't know. I have taken loans in America, and it is easier. I won't say it's easy, but sort of easier. It is easier to know that a given borrower has liens or debt on their name for a given asset. It is indexed by borrower, for example. That is not the case in Uruguay. It is not indexed by a borrower. So even just if you've managed to conceive of a contract, it becomes difficult mechanically to then actually decide whether the borrower should be good for it. And then this creates a final issue on the market side. Right? Because of these difficulties in exactly specifying collateral, in confirming and the risks associated with transfer of such collateral, it is difficult in the marketplace to actually transact quickly when dealing with cattle. And that's a problem because cattle don't live very long. You need to move quickly if you're going to be able to operate effectively in the market. That's not true in America. You can go, I've never done it. I've driven past these places, sometimes in Texas, which is a new experience for me, having moved here from somewhere else. But there are massive cattle markets where one can very quickly transact and buy cattle. There are guarantors. There are people willing to write the contracts on both sides. It's an efficient system. None of these reasons, I will point out, have anything to do with Uruguayans are less capable people. They don't have internet. They don't have power. They're not sophisticated. It's nothing like that. They have the same fundamental systems that American cattle ranchers also have. They merely are lacking some of the necessary legal and organizational incentives to create the behavior of people borrowing and treating cattle as a real form of collateral. That's bad. That's a bad thing. It has results that are negative. It leads to less growth overall. It is impossible or difficult, shall we say, for someone who has a lot of cattle to invest in their own business. They cannot borrow against the future value of their holdings. There's a fundamental degree of freedom that is just missing. It's also bad because of a more insidious reason. The inability to borrow for the average cattle rancher in Uruguay leads to greater inequality because who can borrow? Only those who are wealthy outside of having cattle, those who have real estate or other forms of wealth. So the rich get richer because they're able to effectively utilize collateral and the poor cannot. So I ask you, what does this have to do with Bitcoin, right? Well, first, which environment will we like Bitcoin and by extension other cryptocurrencies that we may be involved in, which is a more rich environment within which to operate? I think clearly the one in which we are able to collateralize, which we're able to borrow against the value of our holdings. Imagine Bitcoin miners, right? It's actually the sort of, if you want to make this analogy, look, I'm not saying that cows are coins. I'm just merely saying that according to the regulations as they currently stand, it is closer to probably say that a Bitcoin is like a cow in the sense that it is a commodity. It is not a stock. It is not a bond, at least as currently classified. So there's sort of an analogy there. Furthermore, we kind of mine and farm for Bitcoins, right? We are able to use, we would like to be able to, in theory, if we're miners, use the proceeds or the future value of our proceeds that we're mining to be able to grow our own businesses. That makes all the sense in the world. Organizationally, we have the best system to be able to use to talk about loans, liens, collateral. Our blockchains are databases. Maybe they're not exactly designed for this, but because of how direct and easy it is to quantify balances, UTXOs, et cetera, it's a natural system. And then finally, you can, of course, transact very quickly in Bitcoin, 24 hours a day to large amounts with very fast liquidity. That's great. All these reasons imply that we should have these kinds of markets in Bitcoin. We just don't today. They're being developed, and I think that's a really powerful and important thing. Going back to the idea of Bitcoin not moving, this is, in my opinion, the reason Bitcoin doesn't move is people lack applications like these that they could otherwise be putting their coins into. And lending is just one of them. It's one that I care about deeply because our company engages in lending every day, but there are many others. The ability to have derivatives, to short your holdings, to create protection for yourself from market volatility. That's another fundamental degree of financial freedom, which is only now coming online for us as cryptocurrency holders. So for all these reasons, our mission is to get Bitcoin to move, and Ether and all the other currencies as well. The pattern that I'm describing is, of course, most clear in Bitcoins. So these are abstract reasons. There's a very much more concrete reason that you all, if you are holding Bitcoin, if you're thinking about it, should be aware of. And that's a very, very simple historical graph that I'll just lay out for you. And of course, as a lending company, I'm going to focus here now on a lending-oriented product. And I'm not going to specify the terms of this loan. You'll see them on the next slide. They're the standard terms that we apply to all our loans. Just take a look at this, this graph. Let me unpack it for you a bit. So again, time left to right. It's a different time period. This is just the last few years, not the full history of Bitcoin at all. Let's compare two scenarios. You are a holder. You need to make a purchase. Whatever. You have an investment you need to get into, you had a real expense, a life event of some kind, you need the cash. What are your choices? You sell your Bitcoin. That's it, right? That's the only thing that most of us know what to do with. So you sell it. You're giving up all the future opportunity of having held that coin. All the future gains you lose out on. Conversely, if you were to borrow, if that were possible. At the time of this chart, it wasn't really possible. There were no lending companies in January of this year that were in operation. You couldn't have done it. But say you could have, how much better off might you have been? That green shaded area, that shows you the advantage, the time periods over which it would have been better for you to borrow. We'll go into, again, the specifics of this loan product here in a minute. There's only a very slim area where we believe it is better to have sold. And you can see it's at the very beginning of this process, the earlier part of this year, when Bitcoin's price wasn't growing as quickly as it does today. Now, you might immediately ask, well, that sort of frames the whole discussion, doesn't it? We're sitting at an all-time high. Of course it is better to have borrowed than sold if we're sitting at an all-time high. That's just obvious. That's true. That's a true statement. But I'd ask you to contextualize that. I didn't just pick these dates randomly. Well, I sort of did. But I actually did the work to go look at this across dates that one would borrow, across dates that one would look back upon. And for almost all combinations, it is always better in Bitcoin's price history to have borrowed as compared to sold. That future price appreciation is always many orders of magnitude greater than any interest rate a lender would charge you, at least over a sufficiently long time scale, such as a year, 18 months or so. And that is, of course, the secret of this, right? We all are holding our Bitcoin because we think it's going to go up. We think it's going to go up over some presumably multi-year time period. We don't think it's going to be tomorrow or next year. So if we're long this asset class over the long term, it makes no sense financially to sell that asset class ever. That's just a very, it's clear because of the expected price growth that we all think is baked into this asset class. And if you don't think that growth is coming, if you think Bitcoin has already peaked, then I wonder why you're still holding it, right? It has no use cases, supposedly, and it's already peaked in value, da-da-da. That's, of course, not the reason. We all hold it because we think it's on the way up. If it's on the way up, don't sell it now. That's what this chart is trying to get you to visually kind of arrest and see. Press the wrong button. What might you do with that loan? What do our customers currently do with the loans that we give them? I'll talk about just a couple of use cases. I'm curious to toss this out as a question to the audience, actually, what they would be interested in. But, you know, I mentioned this, making a large personal purchase, a house or a car, investments in real estate or businesses, leveraging into other cryptocurrencies. We definitely have people who have talked about borrowing in one coin to be able to make investments in another. That's just a form of leverage, another basic financial degree of freedom which is missing. I didn't put this one on there, but avoiding capital gains tax is another really important use case, right? When you sell your coins, if you're doing it right, you technically have to pay capital gains tax. That is not true as directly if you're borrowing. And just because I'm trying to be sensitive to time here, let me run through this last couple slides very quickly, and then we'll turn it over for questions. Yeah, sound good? Doing good on time? Good. Perfect. That's exactly what I need. This is just a very quick summary. You guys can get all these details. Check out our website, unchained-capital.com. These are sort of the starter terms we're offering today. We have a bunch of lending capital we have raised that is committed to these terms. And so I encourage you, it's just a screenshot of our website. I encourage you, if you are excited about these opportunities or you want to learn more, take a look at those numbers, come talk to Joe or myself, ask us questions during this Q&A, and we can explore some of it more. I'll just run through them very quickly in case some of them are unfamiliar. You can borrow up to $1 million of real US dollars, not token dollars or other cryptocurrency, but real dollars. We give loans for between 90 days and 2 years, 3 to 24 months. We're typically charging between 8 and 14% annual interest rate, which is higher than some other forms of lending and borrowing, but it is much lower than we might otherwise have to charge, partly because the way we do our loans, you can see here in the screenshot, is we actually ask you to deposit that Bitcoin into our escrow addresses. If you've used an exchange, it is a very similar process. We have similar multi-sig security that we operate. It's what allows us to then offer those kind of lower rates based on our lending capital providers. It makes them feel very safe that when we lend against a customer's Bitcoin or Ethereum assets, that it's kind of like a very safe form of lending. We've got the actual collateral in our hands, so to speak. We operate in 28 states, including Texas. No credit checks, interest-only payments. And I guess I should have mentioned this earlier. You can see a little bit from the figures in the screenshot. Whatever collateral you can put up, we will lend 50% of the value of that collateral back to you in dollars. So those are the brief terms in summary. I can get into this diagram too. I think this is maybe a little bit unnecessary at this point. How does our product actually work? I can go way into the weeds with this with people offline if they're interested. We use blockchains for safeguarding of the collateral that you deposit with us. It's multi-sig, it's held in there. We're able to show you the address in which it's deposited. You can watch, monitor, and track it the entire duration of your loan. Our lending capital providers can do the same. They fund us with capital. We turn that around, give it back to you. We do operate a website through which all the centralized aspects of this experience, KYC, AML, user sign-up, et cetera, are all handled. And everything is essentially self-service through that process. We're super obsessed with security. We are designed to PCI standards. We don't use hot wallets for any customer funds. Everything is totally cold. And we're fully compliant with all state and federal rent lending regulations. So on that note, I'll just close by saying, remember guys, friends don't let friends sell their Bitcoin. If you need a loan, or if Ether, I keep forgetting to mention that these slides are a bit old, we are now accepting Ethereum as well for our loans. So friends don't let friends sell cryptocurrency because we believe it's going to go up. If you have any questions, and I'm going to be joined now by my co-founder Joe, who's going to join us for the Q&A. You want to come up here, Joe, just to chat?
If you guys raise your hand if you have a question, and when I give the mic to one guy, if you raise your hand, I'll signal when you're next.
Hi. This is a bit of a tangent, but you mentioned avoiding taxes. My understanding of IRS rules today are that if you buy a cup of coffee with Bitcoin, you have to go and declare that as a sale so that you pay the capital gains taxes, short or long term, just on that little bit of money. Is that accurate from what your understanding is?
Yeah, but in that case, you've relinquished your property of the Bitcoin. You're no longer, you've sold it in kind of their eyes. With us, you still it's your
right.
property.
That's my point. If with a regular transaction, you got to go and report that, $3 or whatever, right? Okay.
Correct.
On the 50% LTV, I guess you lock it in at the time that the loan originates, but what happens in a fluctuating market? Can you draw more down against that 50% LTV as it appreciates, or is there a call in a downward trend, and what's the timeline to meet the requirement of the 50% LTV?
Yep. So in an up market, you can definitely take out larger loans as the price goes up. We don't have too strict guidelines around that to date, but kind of make a judgment call on what's acceptable there. For any downward price movements, there's a 25% margin call. That's your first kind of collateral maintenance call, we call it. And we ask for folks to re-top up at the original 50% loan to value in the case of a 25% price drop. If there's a 45% price drop, then the loan is considered in default if there hasn't been any additional collateral put in there. And then you have 2 days to put in at least for the 25% price drop. I think that's it.
So just a quick question, but like in a macro. So when you borrow, if you borrow $100,000 from the bank, they literally loan you $100,000 that does not exist in the real world. They might own 10,000 of it. How does borrowing in the crypto world differ from borrowing real dollars in the sense that there's actually a real limited number, right? So at some point, do you hit a wall, or how does that work?
There's a limited number of crypto.
Take the mic if you can.
So you're saying there's a limited number of crypto, like, or kind
If you have a limited number of Bitcoin,
only
there's,
so many
there's an
Bitcoins out there.
unlimited amount of dollars theoretically because of all the things we wouldn't get into, but like there is a limited number of Bitcoin, right? Which makes the lending world different because you can't create something that's not there, right?
I think you're right, but I think one thing I'll just try to clarify is that we don't lend out cryptocurrency, that we take in cryptocurrency as a form of collateral. So it's not that we're manufacturing or needing to manufacture more tokens to be able to service more loans. You could make that argument, though, on the side of, let's argue, demand and say, hey, there's only a finite amount of crypto in the world for you guys to lend against. That would be a true statement. Is that clear, like the kind of the difference there? Okay.
And then I'll just add, I mean, that it's a function of price as well. So if, as long as the price and the market caps kind of rise, or that's sort of your ceiling of collateralizable assets, so to speak.
So I'm curious, you guys being a lending or a lending company, what's different between you guys and say Salt Lending, kind of doing the same thing?
Yeah, great question. So we've started without doing any kind of token model. So we're kind of much more structured as a traditional lender. We also have kind of avoided starting with too much of a smart contract type infrastructure. We find that can kind of scare some people. It's made some customers nervous where there might be automated functions and things that kind of kick in and let them lose collateral without any control over it. So we tend to be a little bit more higher touch with our customer relationships and things like that. But this is a new area, and Salt is kind of taking their own tack on it, and kind of we're excited to have folks like them helping build up this market of people actually being able to do stuff and leverage their crypto. If you have anything to add.
Yeah, I'd like to add, if you would like to, give someone else a loan by buying their ICO tokens, you're free to do so. If you would like a real loan on your tokens, you should talk to us.
I'm assuming that it's going to be a lump sum once you make the deposit, and it's not like a line of credit. And also, is it payment per month that you got to go back, and is there a prepayment penalty, I guess, as well?
So yeah, try to take those in order. So yes, as loans are currently structured, it's a lump sum. We will offer more of a line of credit type option in the near future, but for now it's a lump sum, so you get one kind of disbursement. Monthly interest-only payments from the basically due every 30 days from the starting point of the loan. And then the last question with, and then no prepayment penalty. Yeah, certainly no prepayment penalty.
I'm going to put you on the spot, but it's because I care. I'm a CPA and I'm interested in the solution, but I'm kind of surprised that the rate is so high, particularly if we're taking advantage of not having third parties. Can you just speak to that a little bit?
Interesting, good feedback. I mean, we get depending on what side of the market we talk to, we get different feedback on the interest rates. Right now, they're mostly a function of the capital providers that we can work with. And so most folks that are already in the kind of credit and lending business, look at Bitcoin as kind of this risky asset class. Even though we're already doing this 50% loan to value and we feel well hedged and got good infrastructure to protect principal, they still, look at this like, oh, I can lend against property in New York and have a senior secured lien on some apartment in New York and lend at 15% interest rate, or these kinds of things. So they, from a kind of a equivalency basis for them, they've just not yet gotten comfortable with Bitcoin as an asset class. We think that's going to change. We think us and other folks that are engaged in this market are going to help bring people on board, help them realize that this is a safe asset class and a safer asset class to use as collateral, and we think that's going to drive interest rates down over time. Yeah. Lenders? Yeah, absolutely. Yeah, should absolutely talk to us.
Yeah, ultimately, I think we're interested in a range of rates. Just to repeat what you
because I'll
said.
take that rate.
Yeah, I think, yeah, perfect. I think just to repeat what you were saying, we are super interested in a range of rates ultimately. This is where we're starting today, ultimately driven by our lending capital providers. As Joe mentioned, we do see the rates going down long term for the form of lending that this in particular resembles most, which is margin loans. And it's a very safe form of lending, and lenders who perceive it as a form of margin loan view this rate as very generous, and they're happy with it. Those who perceive it as some riskier class of lending need a little bit more education. So that's kind of what drives that. We ourselves, as holders, like the idea of lower rates for borrowers over time. That's great. It also, as a company, lets us do more interesting things and make more interesting products if we can access capital at those lower rates. So it's a developing story.
Can I ask a question? And I'm just inserting myself, so I apologize. But does this kind of lending hold promise to providing capital to more people? Because in the current financial markets and financial system, you really have to qualify. It doesn't matter what you own. It doesn't matter what assets you might bring to bear. You have to qualify to get a loan. And yet somebody from Venezuela could give you Bitcoin and you'd be just as secure as if they were somebody downtown New York City on Wall Street. Well, wait, never mind that. Someplace else, maybe Omaha.
Yeah, absolutely. I mean, I think for now we're limited in our scope to be able to just work with folks in the United States. In the future, we'd like to work with more countries and folks that might not have infrastructure like this to be able to get lent on assets. We do think it's really exciting to look at as more assets come onto a blockchain or tokens become to represent more real-world things, that this kind of token-backed lending or crypto-backed lending can really expand the scope of types of offerings out there.
Yeah, I would just add, I'm not sure if this was the spirit of your question, Paul, but we're certainly interested in being democratic and lending to as many people as possible who are, of course, good standing citizens, not criminals and terrorists and all those provisos aside. Yeah, we're not necessarily interested in credit scores right now. We don't, for example, do credit scoring today because our loans are collateralized. So as long as you, quote unquote, have the Bitcoin and check all our other requirements, not a bad guy kind of thing, then we're totally comfortable with it. But in the spirit of it, we're not in a position to be able to lend small amounts in a very broad way like across the planet. That's a very, I think, different kind of business, potentially more of a peer-to-peer driven model, and just practically even from a technology and regulations perspective, we're just not built to do that business. That our entire application design is oriented around high security, higher amounts, slower and more human-oriented access, which tends to limit our scale a little bit. And then regulations-wise, we're simply not allowed to lend small amounts in many places. That's just the way that the laws work out. It's easier for us to actually give larger loans than smaller loans. In many states, we have significant minimums to be able to even operate. So,
actually, I was just thinking of your Uruguay cattle and your U.S. cattle. I mean, they're both same profile.
Right.
But you know, this other observation is that you actually take control of the asset, whereas a lien doesn't actually give you control of the asset. So the risk is really on the other side, not on your side.
And I'll just add that people who have maybe 90% of their net worth is in Bitcoin and 10% is in traditional assets, like even them would have trouble getting a loan today, just even though they've got however many dollars amounts worth of Bitcoin, banks won't recognize it. It's just not recognizable collateral.
So I guess two questions, not to be a Debbie Downer either. What happens if you guys, say go bankrupt or your company, just shuts down? What happens to, is there any consumer protection for the collateral that you guys have of our Bitcoin? That's the first question. And the second one is what you're referring to with you're not checking credit scores, but you're trying to check if a person's a criminal, what's that process going to be? Is it still going to be a background check or whatnot? So.
Yeah, maybe I can take the first one and hand it over to you for the second one. Joe does the background checks in our company. I'm unreliable. So I think I just wanted to tie it also into your last question, Paul. It's true that today our loans are very secure from the perspective of the lender because we take direct possession of the collateral into an address which we fully control. It is a multi-sig cold wallet, but we hold all the cold keys. We are very interested in exploring other models as well, everything from the opposite of that, which would be totally, loans in which we're not taking possession at all, that the customer is allowed to continue to keep the collateral in their own addresses, but the interest rates are much, much higher. That's an interesting product. And then things that are in the middle, that we're not just taking all the keys, or the customer's not having all the keys, but we're sharding and sharing keys with our capital providers, with the customer, and with ourselves. That's ultimately, I think, a very much more interesting model for us. We are holders. We understand that trust is one of the most novel aspects of blockchains, and we're kind of doing it in a very naive way today. That's partly just a recognition of that it's still early slowly, and we're trying to make everybody comfortable. Over time, we want to move to a more blended kind of trust model. And I know you have a question sitting next to Debbie Downer, but let me hand it over to Joe to answer your question about the KYC AML stuff.
And only that, we do have business continuity plans, such as, if anything happens to folks in the company and these types of things, the collateral assets will always be able to be, in worst case scenarios, there's things that can kind of kick in to make sure client assets are still available. On the sort of background check question, no thorough background check, but we do have an anti-money laundering, know your customer process. We do ask for some personal details. We were just joking about, though, like compared to a mortgage loan, we're about 5% of the paperwork and questions, kind of things you'd have to deal with. But we do just do some simple searches around the appropriate databases to make sure no one's flagged for not being able to transact in the U.S.
Okay, just for a use case, say as a consumer, I invest, or I send you BTC. Do you guys basically maintain the private key, correct?
Correct.
So what if there's a hard fork like Bitcoin Gold or Bitcoin Silver? Will you guys provide those that currency?
Yeah, so they're your property. I mean, that's the first thing to say, is that anytime we're holding someone's assets, it remains their property, and so any derivative forks or other cryptocurrencies that come out of that are continue to be the client's property. Given the nature of these forks and that they're technical challenges, we can't promise or guarantee they're going to be available right away or anything like that. In the past, with Bitcoin Cash and now Bitcoin Gold, typically the client just asks for us to send them their assets, which we do, within a certain amount of time that we can support them. And in the future, we'd like to offer, when there's chains that are viable or forks that folks want to have supported as collateral, then we can add that to their collateral balance with us as well.
This is not kind of related. What do you guys think about lending pools for the people who are unbanked in like third world country? Perfect token would be like We Trust. I don't know if you guys know about that. Could you comment on it?
Yeah, I think those are exciting. I think a lot of the peer-to-peer sides, there can be certain challenges to them. One is kind of around interest rates sometimes, and getting good capital into there, because we find that when you want to try to offer people lower interest rate loans, you tend to need to find bigger pools of capital that are more comfortable with lower interest rates, on a bigger base. It's like if you're on a peer-to-peer platform and I'll lend, $50 to people, or I'll lend like $100 to people. You're generally doing that looking for like 5% or something like that. You're trying to look for 15 or 20%. So you sometimes hit these kind of issues with, I think, those peer-to-peer marketplaces that are based on a lot more smaller amounts, that all the lenders on there are looking for bigger returns, 20% kind of thing on their $100 loan type of thing. So that doesn't always create the best experience for borrowers, because the capital is not wholesale. It's almost retail capital that's coming from individuals. So I think it's cool. I do follow We Trust. I think it's an interesting model, and I want to see how those develop and work. But certainly there's outside of the marketing and onboarding into platforms like that, there are some of the structural challenges with, I think, interest rates and how to make that work.
The interest and fees, do you pay them in US dollars or tokens?
US dollars today.
Do you have future plans that you haven't told us yet? Secret sauce that's, are you going to get, you talked about Ethereum and Bitcoin. There's a whole bunch of perfectly legitimate, perfectly secure tokens out there. At what point do you just take over the world of lending?
Man, that's a great question, Paul. Thanks. I'll split up maybe into a couple parts. I think other tokens, we're super excited about expanding to other tokens. Partly that's a technical thing, partly it's a price stability thing and liquidity thing. I think there are many more exciting places to play. I think, as everyone knows, these tokens have different support requirements, and so we just try to take it slowly and listen to our customers. What they are asking us to lend upon is what we sort of prioritize. Do we want to take over the world of lending? I think that'd be really exciting, sure. I'm not sure in the short to medium term that it'll be that crypto lending necessarily is this massive thing that we get to own and operate. And there are other players in the market, and two, despite how large and awesomely growing the space is, it is still small compared to the scale of lending on homes or student loans or any of these kinds of other areas. We are still considered in the lending space a niche lender with a small market to go lend against. And that could change next year if the price has another big swoop, and we're aware of that. But at the same time, that I think guides our strategy, and that lending is a very exciting first product for us to bring to market, but there are many other things that we think our technology and our ambition kind of encompasses. So beyond lending, I think we started to suggest it in the audience, we're taking in a lot of cryptocurrency. There are things that one can do as a financial house with assets like that. We, for example, today don't re-lend out any of that crypto in any way. Creating the scenario, which I think the gentleman in the back was describing, of money being created from nothing. We don't do things like that today. The funds that we take in are locked in an address that you can control and see the entire time. But we are very excited about developing various classes of products in the future that do more interesting things and branch out beyond that. One obvious category is being able to lend out the cryptocurrency just as we are lending out fiat. That's very clear and simple. I think there's some more interesting options around insurance and other kinds of product verticals that we're really excited about too. So I don't know the answer, Paul. Let's look at that. I think what's exciting about lending is that it's simple to get started. The regulations are clear. The technology is approachable by our team, and we feel very secure about it. And we think that there's good demand. So that's kind of what we're out here doing and finding out. We encourage all of you, if there's some other kinds of financial instruments that would get you to move your Bitcoin, which is, of course, our mission, please tell us about it. I'm very curious to learn more.
My question goes around the fact that currencies and cryptocurrencies are based on anonymity and privacy, how do you know who you're lending to?
Sure. Yeah, great question. I mean, when we engage with a client, if they would like a loan from us, first they have to fill in some personal information on our website. So that it's a simple form, but we do ask for things like social security number, birth date, first and last name. And we, like I mentioned, we do kind of some searches on them just to make sure there's not a red flag in any database on them. And that's relatively it. That's almost about the best we can do. It's best a lot of folks can do. Not dissimilar from exchanges. If you want to get an account in an exchange, and what you have to deal with there. It does. If people want to transact, if they want to access products like this, it does, because it touches fiat. You do have to kind of ask these of people if they kind of need to come out and give up some information if they'd like to have access to it.
I think there are some really cool projects out there that are totally anonymized, distributed, peer-to-peer, crypto-to-crypto lending kind of products. I think they're really exciting and cool, but that's not what we do.
Okay.
So I think in those arenas, you can have that anonymity and obtain that liquidity and leverage. It's just because of our connection to dollars, we have to obey the regulations that we're under, and that leads to this kind of information.
So in fact, the money that you lend will go to a particular place that you kind of control?
The money that maybe the collateral that you would post,
No, the fiat money.
The fiat we would send directly to your bank account via ACH or wire transfer, I forget which.
But somehow that's the way that you really know who you're lending to.
Yeah, and also, to be honest, we typically have either met or talked to our customers also. We do not have a self-service, completely anonymous, never interact with us kind of model. It's fairly high touch today. Other questions, guys?
Is the federal authority or regulatory authority that you require?
I mean, there's a couple. So there's fortunately not like a federal lending. Anybody need a license from lending tends to be regulated on a state-by-state basis. But there's the Consumer Finance Protection Bureau. There's the Bank Secrecy Act stuff for anti-money laundering issues. We're not a money services business under FinCEN, although we do have to file suspicious activity reports. So it's at least at the federal level, those are probably the big three things that we pay attention to.
I think part of the reason we were excited about lending is because of that regulational clarity and ease with which we could get started. In a state like Texas, we've been giving loans for 6 months. We're not licensed. We're becoming licensed, but it's a very friendly environment within which to do it. Anybody in this room could lend to anybody else. It would be easy.
You have 1 minute to close.
Questions, guys? Who wants to ask the final dramatic question? Favorite coin? Oh, that's a loaded one. I guess Bitcoin, we're kind of OGs on that stuff. Thank you for your time, guys. Yeah, come talk to us. We're very approachable. Come say hi. We have a booth in the back. Thank you, guys.